So what I think of is that there are parts of the market that are going to do very well over the next 2 years, and those are non-tech parts of the market. And we've been advising our clients of that and really to rotate their portfolios that way, over the course of the last 2 months, because technology, as Stanley Druckenmiller said, is very highly valued, and it's very hard to discern what companies are going to do well and not if all of them are doing like they are.
And yesterday, David, we did see strength, not just in the tech names on the rebound, but also in some of what we call the COVID recovery plays too, whether that's hospitality, travel, but also in some of the unloved sectors, even like financials, that were getting a boost. Are these names you like?
We do very much, and I'll explain why. Let's just take a look at the financials. Next year, you're going to have the yield curve steepen, in our opinion. That means that banks and insurance companies will make more money. We think that the reserves that they're taking now for loan losses will stop in 2021. And we have to remember that the stimulus that's been applied to the global economy is between $10 and $12 trillion. It is 8 times the amount of stimulus that was provided in 2008. So not only are we going to see a recovery, but we're going to see a strong recovery once a vaccine and treatment have been identified, which they think could be at the end of this year or beginning of next year. So we like the financials very much.
David, good morning. Thank you for joining in this conversation. What about the market's move from here in anticipation of the vaccine delivery and the economic recovery coming in the following quarters? Do you think the market has pretty much made its gains in anticipation of that?
So I think your question is exactly right. If you're just going to buy the index itself may be up 5 or 6%, and it'll have a pop due to the healthcare improvements and things like that. But there are places in the market that you can make 20 and 30%. If you take a look, for example, in some of the unloved parts of the market, whether it be travel or certain parts of retail, hotels, as I mentioned, financials, insurance companies, certainly of the small and medium-sized companies. And I'll give you one area where you could probably make 50%, and that's in Latin America. Take a look at how far down Mexico and Brazil are. These valuations in emerging markets are literally at 50% of what they were. Take a look at 2016, 2015. So with the U.S. coming back, we think the Latin American markets can come back as well. So there are plenty of places for investors to move money. The key is to not follow the crowd. If you're just going to follow the crowd and buy technology on momentum, that is not, in my mind, a sound investment philosophy.
Right. So are you saying that now is a good time to look at the unloved sectors? Because that was a theme that came out from our previous conversation yesterday with Howard Marks as well. But I want to understand the timing here of when to get in.
So I'll just answer it with one word. The answer is now. You can't anticipate when a new rotation is going to start. But what you can anticipate is when valuations are disproportionately out of line. And right now, when you look at the stay-at-home stocks versus the leave-home stocks, you're finding that the stay-at-home stocks have done great. Once people are able to leave home, those stocks are going to do great. And that's why you need to rotate those portfolios now, from large companies to smaller companies, from developed markets to emerging markets, from the technology stocks to some of the less loved sectors, like you pointed out. And you do that now. And you begin to rotate your portfolio over the next several months, anticipating what we hope will be a vaccine and other treatments that will allow the other 15% of the economy that's been devastated by the pandemic to recover.